Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Wesly Pate, Senior Portfolio Manager at Income Research and Management, to discuss how the demand for municipal bonds is evolving and the implications it has for market dynamics. Wesly, it's great to have you with us. Welcome to Trade Talks.
Great. Thanks for having me, Jill.
You got it. What's your outlook for the municipal bond market in 2024?
Yeah, it's a great question. So it's sort of looking forward for expectations of 2024 is really continued strength. And really that's going to be largely driven by, considerably lower levels of supply relative to history and relative to other asset classes. So really when we think about what's going to drive municipal returns over the near term, munis will largely take their cues from treasuries. So as we enter into a period of the Fed starting to cut rates, along with them continuing to be the victors when it comes to battling inflation, it really bodes well for the municipal asset class. So looking forward, we expect absolute levels of strength for the municipal market. That being said, from a relative perspective, we would actually expect the asset class to slightly lag treasuries and other asset classes. Typically speaking, munis tend to lag other asset classes in a rally, and that's really what we're expecting here over at least the near term.
Are there any specific sectors within munis that are showing notable strength or areas that you're seeing value?
Yeah, the market continues to gravitate towards the areas of the market that continue to compensate with the greatest amount of yield. So when we think about incremental spread over sort of the baseline AAA munis, really that's where strength is most present. So those sectors really include airports and hospitals in particular. Hospitals have meaningfully lagged the broader asset class really for the better part of the last 2 years. And a lot of that's to be expected. It was really the one sector within the asset class that really faced continued headwinds as far as credit strength. So rising expenses and lower reimbursement rates for a long time really allowed those spreads to now become incrementally more competitive versus the broader market. And so we're starting to see a bit of a catch up, given the fact that spreads there are starting meaningfully wider than the broad asset class. You're going to see investors start to really stretch a little bit and add in that space. And it's important to think about the value of that spread in a higher interest rate environment, and from a tax equivalent perspective really adds a meaningful amount of value relative to other asset classes. So hospitals are very much poised to do well. Credit is continuing to strengthen. The technicals in that space are also very strong, just given lack of supply. And then again, you have the natural investor demand that continues to be robust. So it's probably the area of the market that we think you're going to see the greatest amount of relative strength looking into 2024.
Wesly, how has the demand for munis evolved recently, and what implications does it have for market dynamics overall?
So the demand for munis, the way we really describe it is that it's cumulative. And so what we mean by that is if you really look at the asset class over the better part of the last 5 to 10 years, what you've seen is investors that have entered into the asset class have not left, but new entrants continue to emerge. So while corporations have largely stepped away following the Tax Cuts and Jobs Act of 2017, individual investor demand has only grown. And so what we continue to see is that as new entrants come in, and there's really just this growing demand for both a safe haven as well as a tax haven or tax efficient asset class, that continues to drive demand. And so you really are looking at two very dynamic factors: increased demand coupled with a lack of supply. And when you really put those two factors together, it really highlights just why we should continue to expect, very strong performance, at least relatively speaking, within the asset class.
How does the current macroeconomic environment affect the risk-return profile for investors in the muni space?
Munis are arguably the most well-poised asset class when you really think about all those macro factors. So, I think top of everyone's concerns right now is largely geopolitical risk. And if you really start to dissect geopolitical risk and how it can affect various asset classes across fixed income, whether that be, government securities, securitized corporates, but really looking at municipals are arguably the most well-insulated asset class from all of those geopolitical pressures. You really have a lack of systemic risk in the muni market. So what we mean by that is when one credit might suffer deterioration, it doesn't mean that you have this cascading or domino type effect that affects other credits. And so, what's going on overseas is really going to impact other areas of the investment portfolio, but munis historically have been the most well insulated against those sort of pressures. And then thinking about other macro type risk, inflation starting to, erode. And so that continues to be beneficial. And then also, on the geopolitical side, we're also coming into an election cycle. We usually get the questions of, well, how will an election cycle impact the asset class? And it's always interesting that there's usually some short-term type movements in terms of volatility on a relative basis. That said, they usually ebb and flow rather quickly. So we wouldn't expect to see any sort of sustained weakness or strength just as a result of the upcoming election cycle.
And finally, with the first Fed meeting of 2024 coming up, how could the anticipated rate cuts impact municipal bonds in 2024?
So it really bodes well for the asset class today. It really highlights that if you're expecting rates to incrementally drift lower from here, and if you do expect the Fed to long-term reach that 2% inflation targets, then we should expect cuts going forward. That would really highlight that, entering into the asset class today is more beneficial than tomorrow. And so, the Fed is ultimately going to serve as a meaningful tailwind for absolute returns across most fixed income asset classes. But the one thing we would always highlight is that the classic rule in fixed income is that if your time horizon is greater than your duration of your portfolio or the duration of your assets, you benefit from rising rates. And so if rates were to climb, ultimately most investors would be, well served to actually be in the asset class near term, because over time the reinvestment will be beneficial to them. But if rates were to fall, they're definitely going to want to be in today to experience that at least near-term tailwind. So it really sort of highlights the defensive nature of the asset class for a long-term investment perspective. But ultimately, the Fed's actions that are upcoming, at least over the course of the next 12 to 18 months, are likely to serve as a benefit, at least near-term, for investors in the asset.
All right, Wesly, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.